Investors Chronicle.
Hello, you are listening to the Investors Chronicle Companies and Markets show, bringing you the big listed company news and goings-on at the moment as of our recording date, which this week is Thursday, the 22nd of August. This week, we will begin with one of the big UK turnaround stories of the year, share price-wise at least. That's contractor Costain. Company's editor Mark Robinson will be discussing its rejuvenation and its interim results shortly. Then a takeover story that will resonate with more investors than usual, the private equity acquisition of the country's largest investment platform, Hargreaves Lansdown. Personal finance editor Val Cipriani is here to discuss what platform users should do next, while Julian Hofmann will give a rundown of the company's financials. And after that, we'll look at FTSE 250 oil and gas producer Ithaca Energy, which is in the middle of a big acquisition of its own, as well as dealing with the government's expanded North Sea windfall tax. Alex Hamer will hold forth later on. We start, though, with construction and engineering group Costain. Mark is not quite back from the dead, but it was certainly on life support a few years ago. Now, it's in fairly rude health, as per the figures. What did they look like, and how did the company get here?
Well, to me, when I looked at the figures afterwards, and I should point out that our colleague Gemma Slinger was the one that actually put the results together, but to me it seemed like it was an exercise in prudence, really. And that should always be welcome, of course, because as you alluded to before, the company had some dreadful problems 4 or 5 years ago, and the residual effects are still there. So it seems fairly clear to me that management has taken a rather hard line in the intervening period as well. The results themselves were good enough. We saw an increase in adjusted operating profit up by 8.7% to 16.3 million. And importantly, that was matched to a large degree by the related operating cash flows too, which hasn't always happened in the past. It's a feature of companies like Costain, where they have come unstuck previously, is that they've often tended to book profitability ahead of cash flows coming in. And while it's understandable why cash flows can be somewhat lumpy in a business like this, I think in the past, a lot of these kind of companies, and I'm including the support services network in this as well, have taken a somewhat intemperate view from an accounting perspective. I guess when you think about it, the industry as a whole might have a lot to thank Carillion for ultimately, because there does seem to be a push away in favour of a far more prudent outlook as far as the contracting part of the business, which is central to it as well. If you look at Costain, for instance, they seem to favour now higher margin consultancy work a lot of the time, and they've tried to push away from cyclical parts of the economy, although that's pretty difficult given the areas that they cover: transportation, water, energy, and defence. But the main point is there that the improvements are evident in the operating margin, which has gone up, and that work is a little bit more predictable in some respects too, at least as far as cash flows go too. So yeah, I think it's a lot of important self-help measures, but just the overall scope of the business, to me, perhaps the overall scope of the sector has changed. When you think of the impairments that they took 4 or 5 years ago, as we mentioned, it's taken an awful long while to leach through the system. And it's also noticeable as well that they've altered the way in which they look at their order perspective. So the total order book is £4.3 billion, but of course that's only made up of a central order book of 1.8 billion. The remaining 2.5 billion relates to work that's in the pipeline but is yet to really be confirmed, let alone revenue generating itself. They've got a decent cash flow at the end of these figures too, 173 million. and that provides a bit of a buffer for uncertainties or any market downfalls, which is important too. The companies live or die by their cash resources,
Yeah.
and it's pretty well set as far as that goes. And uh, in a moment, I suppose we're going to talk on the valuation as well. But it sort of when you square off the cash balances, there's some interesting results there too.
Yeah, the cash really is crucial, isn't it? Because that was as is typically the case, the reason why they needed to raise money in 2020, I think it was
Yeah,
the lack of cash in the business. Frankly, they have changed focus. Try and focus now a little bit more on government and regulatory linked projects, which we can maybe come to in a moment as well, in an attempt to remove the cyclicality from the business. HS2, or what remains of it, is a big contract for them, and has been for the last couple of years. And in these figures, you also saw a buyback, which sort of speaks to the strength nowadays of the balance sheet and the ability to do that. But at the same time, I think you're right to say they were quite cautious, weren't they? There's some
yeah.
suggestion that despite the order book looking quite strong, they haven't really said in terms of their guidance for the second half of the year that they're not making big promises. Clearly, very much keeping in mind what happened a few years ago. They don't want to get ahead of themselves. But why don't we come on to valuation straight away then? Because as I alluded to at the beginning, shares are up, I think, 50% this year. Over 1 year, it's over 100% now. They're still far, far below where they would have been several years ago, taking into account the rights issue as well. But uh, it's clearly got a lot of momentum. How do we see the metrics at the moment?
Well, when I did look at that cash pile that Gemma alludes to in the article, uh, it, even without it, though, the multiples look pretty good. It's trading on a forward PE multiple of 7.3 times, but that actually falls to just slightly below 4 when that cash is factored into the equation, or 2.7 times enterprise cash profit multiple. And you think, oh well, that's fantastic numbers there, because the market is ascribing relatively little value to the core business, which is something of a worry, really. So there's still a hangover going from the problems of a few years back there. But certainly that multiple 4 times enterprise cash profits is should attract at least some buyers who are, if they're confident that this is part of an overall trend. And as you say, they're kind of under promising in terms of these results. The whole industry uh, seems to have been flipped on its head, really, by the problems of Carillion and others too. Uh, it's strange because there's when you think of a company like this as well, you tend to think of one that's sort of got heavily invested in sort of fixed term capital assets, um, and it seems like Costain is actually trying to move away from that model, because obviously you've got an awful lot of capital that's caught up in business like that, and that makes it difficult in terms of the contracting process itself, and the margins, regardless of how well they perform this time around, are still fairly thin compared to a lot of industries,
Mm.
and the cash margin too. Gemma quoted a Pamela Liberum note that said that free cash flow yield is expected to jump to about 13% next year, which is not only good within the industry, it's good on an overall basis too.
Yeah.
So, I I would have a certain amount of confidence in prospects going forward. If for no other reason, then the whole outlook seems to have changed from management. It's been a while since I looked at the company, actually,
Mm.
and it does seem to have gone through something of a sea change.
It's fair to say, though, isn't it, nonetheless, that the market perhaps doesn't really share that confidence as per some of the metrics. Clearly, it has the momentum. It's up 100% in a year. But at the same time, when you're still trading on pretty, pretty bombed out valuations as the sector as a whole, it reflects the issue with contractors, perhaps, which is never really going to go away, and which we've had a lot of reminders of in recent years, is that when you lose a big contract, certainly now Costain is working with the likes of the government on certain projects which help reduce the cyclicality, but equally mean there's a big contract risk there if something were to go. And ultimately, with contractors, you never really have visibility over what, say, the government or whoever else they're partnering with is going to decide.
I don't know if this applies to Costain at all, but certainly when you go back and look at some of the construction and support services companies in the first decade of the millennium, there was an awful lot of growth being priced into these firms as well, and it's pretty hard to justify when you look at the businesses they're involved in. They're not it's not a tech rating, although at times you could have been forgiven for thinking otherwise. So, you know, perhaps the market itself has become more circumspect just as management has done. We seem to have been at some point caught up in a fever about this as well. When you look at the early part of the millennium too, with support services, there was all the sort of fever around PPI contracts, and I think when Michael tipped the company or outlined the investment case rather, he did say that what's happened since then has been a bit of a race to the bottom, or at one point it was a race to the bottom in terms of contracting and the tendering process. I mean, this is a problem for businesses, no matter how big they are in construction. That whole tendering
Indeed.
issue.
Well, there are still contracts coming through as well. There was the one with the Southern Water announced after the period end, which is
Yeah.
a fairly big deal. So they are still winning deals, irrespective of what happens to existing ones, and there's still a decent amount of HS2 work to come, maybe some more, depending on what happens with the rest of that project and what happens at Old Oak, I think, as well.
I guess there's a caveat there
Hmm.
insofar as any contracts that you do have which are linked to either a central government or municipal finances, money is rather tight at the moment.
Well, yes, indeed. Uh, the other thing we should go back to, just to wrap up, is the consultancy work, which they're trying to do more of to, again, reduce cyclicality, and they do seem to be doing that at the moment. So that's something to keep an eye on. If they can keep pushing that kind of work, it gives them a little bit more insulation. But ultimately, there are still they are still a contractor, and they're still going to be bound by the general rules and rules of thumb we should apply to the sector. Let's talk now, though, about Hargreaves Lansdown, platform on which many listeners, if they hold Costain, may hold the shares on Hargreaves because it is the country's biggest platform. It has just agreed a takeover deal by a private equity consortium, which includes CVC and some other players, but CVC are the main one everyone knows in there. There are a couple of bids before the deal was accepted, but seems fairly safe bet at this point it's going to go through. Val, first things first, how should users of the platform be thinking about this deal, or what should they be doing, if anything?
Yeah, really, in the short term, I guess it doesn't change very much for people who just use the platform to invest. Basically, on the sort of safety of the money side, if anybody were to be worried, the platform space is really very tightly regulated by the Financial Conduct Authority, and those protections are in place regardless of whether the parent company is public or private. And also, generally speaking, Hargreaves remains, as you say, that it's the biggest platform out there, so there isn't really any big concerns in terms of it suddenly going bust for some reason or anything like that at all. They've also been quite explicit on the fact that they're not expecting to make any immediate changes to their products. So I think in the short term, it's quite business as usual. Just in general terms, if you're happy with the service they provide, you can just stay on and keep using the platform without being worried about it. Of course, things are different, if you have complaints about the platform, but that kind of thinking about a transfer is somewhat independent of what happens with the takeover bid.
There is a shadow perhaps overhanging this whole thing, though, in that Hargreaves has begun a technology upgrade, which is a vague term, but it's going to be changing a lot of the back end stuff over the next few years. And that's part of the rationale for the deal from, or at least the stated rationale from the consortium as well, saying it needs time and change to make this transformation, and this is best done, as you'd expect, without all the requirements of a public company, which I know our colleague Alex Newman is a bit skeptical about. I can see the rationale on that front, because looking at other replatformings, as they tend to be called in the industry, other platforms who've gone through this, is very hard to do it without some kind of at least short-term tech issue, whether that's just a couple of days when they change over and things haven't worked out. And I say a couple of days, it probably ends up being a couple of weeks, a couple of months maybe, where people get frustrated, but you could see that becoming a big reputational issue. So for users, that's not much solace, because it does tend to be the case that those things will happen regardless. But for investors, you could see them getting panicked about it. The flip side, I suppose, is we've got to also think about what the consortium, what the new owners will want. Private equity is not typically known for investing large amounts and not wanting to make a return. So there is the question of what this tech transformation will involve, and whether it'll be done any better under the new owners, and maybe what users should be thinking about in light of that, because Hargreaves has been under pressure, hasn't it, in terms of service levels, and arguably needs to do something.
Yeah, I would say that. Yeah, so first of all, the issue is that it's a very competitive space, and Hargreaves is quite an expensive platform. It depends on how you trade, what kind of assets you hold, but generally speaking, it is expensive. And when you're sort of talking about it, you're like, well, it is expensive, but you do get like really good service in return. And then it turns out that the service is maybe not as good as it used to be. They've had some like issues with the helpline in the sort of year to June 2023, where basically the customer satisfaction dropped a bit because they just had a big number of calls, and it looked like they were not able to fully keep up. So there are some kind of like issues there that somebody sort of needs to think about if Hargreaves is to sort of start growing quite quickly again compared to the cheaper competitors. It would appear like this sort of tech transformation that they need to do is a big part of it, because the legacy technology is just not very good. They're having to do loads of things manually, so it drives costs up, and it means that they cannot fix other things or become more competitive. So that kind of in general, whether it's better done as a private company or a public company, I was also quite skeptical of what the private equity group was saying, just in terms of, this is a private equity group that wants to acquire a company, and they're saying it's better for the company to be private rather than public. Well, yeah, they're gonna say that. I think, that there will be definitely like some changes, not all of them necessarily for the better, but it is on a longer time scale. I mean, ultimately, if users have complaints around like the digital side of things already, the theory is that if the legacy technology does get improved, then also afterwards they should get like better digital services, but it is more of a long-term fix in that sense.
And you'd have to think at some point, in some facets, the consortium will want to take costs out of the business rather than necessarily investing in service or cutting fees, for example, which would be the two most obvious ways to not to regain market share, or maybe to regain market share. They still have a big market share, but to become more competitive as well. I suppose the counterexample on one level is Interactive Investor, which was acquired by Aberdeen a few years back. Not much has changed there. That said, they maybe didn't need the big tech transformation. It might look like it sometimes on the front end, which is less flashy than Hargreaves, but on the back end, they haven't been going through this big tech transformation. So there's been less of an impetus, I think, for the owners to make big changes. Julian, let me bring you in here, because you've been covering the company for a while during its history as a listed business. What do you make of the takeover and the state of the company at the moment?
Well, I guess to paraphrase Caroline Ahern, what first attracted private equity to the Hargreaves Lansdown's 1.8 million customers and 636 million of net cash?
Indeed.
I think it's a fairly obvious reason why they went for it. But there is a sense that the company had been drifting, over the past couple of years. Net income earned from interest rate on deposits has been a big component of their profits, something like more than 20% now. And there was a sense that they weren't keeping up with the times, and smaller and nimbler competitors like AJ Bell have been really cleaning up the market, particularly in specialist areas like pension drawdowns, and even Interactive Investors has attracted that more sort of regular and discerning trader type of investor. So what you're left with is a company that has a a very big reputation and mark, and appeals to a lot of people, but who don't necessarily spend a lot of money on it. So that's it was in a paradoxical situation. The only shame, I think, from an investor's point of view, is that they won't see whether the turnaround plan from a relatively new management team would have made the situation a bit more tenable. But if you had bought in at our recommendation at the beginning of the year, you're sitting on a pretty nice profit as a result of this deal. So investors from that point of view can't complain. But I mean, they're only effectively paying, the published price was 5.4 billion, but the consortium was only paying 4.8 billion of that because Hargreaves has so much cash. It generates so much free cash flow. My interpretation, along with Alex Newman's, is that this is probably a play to get a debt-funded dividend out of it in the long term for these PE players. And I can't really see that it makes any difference to the final offering, whether it's a public or a private company, personally. But it had been drifting. That's the reason why the shareholders decided to give up on it, because they weren't 100% convinced that it would solve its problems internally.
As you say, there is a new management team, well, relatively new in terms of how long the CEO, CFO, chair have been in place. It is a shame in some ways not to be able to see those plans, but then the market might have viewed those differently as well. We talk about the service standards and how it historically has prided itself on good service and good system. As I alluded to with the front end, it is still quite a relatively slick interface by platform standards, because a lot of big platforms, despite all the assets and money they have on them, can still lack something when it comes to even engaging with them, in my experience, and I think some of our readers' experience, in terms of how you interact with the service online or on mobile, things like that. So they are coming from a high base, of course, Hargreaves, as they are with market share. They have been the market leader for a long time, and it's more about that being eroded slightly and what happens next.
And they retain 91% of their customers. I mean, there's no question that there's a stickiness to the base. It doesn't move very far or very often. I think, from a private equity point of view, it's an astute piece of business. It was about 16 times earnings. It's not anywhere near as expensive as Hargreaves has been in the past. You'd have had to pay 2022, something like that, even 5 years ago.
Yeah, even quite a bit more.
And in a sense, they have sold out fairly, but not expensively, if that makes sense. I don't know. We will see if they. I think they'll be around for quite a long time, but I doubt that there'll be a material change to how it runs or how it retains its customer base. I think people will just stick with them because they've always stuck with them.
Part of the reason, we should say, for I'm sure Val would say as well, part of the reason for high retention rates on platforms is, of course, it is very difficult to move platforms depending on what assets you have, certainly pensions, things like that. But equally, there's a reticence to move because you'll be out the market and you're not sure how long that will be, things like that. But
it can take weeks and weeks.
Well,
especially if you're trying to move shares. I think it's slightly easier if you're moving cash, but yes. So they have the marquee name, and they have the costs that go with it. And if you're prepared to accept it, then perhaps that's not such a bad thing.
Indeed. To clarify, I should say that that's the same for pretty much all platforms. It's a bit of a nightmare moving whoever you're with and whoever you want to move with, but that's a different story that we've covered at length, and we will probably continue to do so until it improves. Anyway, let's move on. Let's talk about Ithaca Energy, Alex. Results out this morning as we record. A lot going on here. As I say, there's got an acquisition which is going on. There's a lot of attention, of course, on what the revamped, shall we say, windfall tax is doing as well. But what did you make of the figures themselves, first of all?
It's an interesting year for Ithaca because they're in the midst of this tie-up with Eni, Val. How do I say that? The Italian energy giant?
Eni, yeah.
Eni, thank you.
Solid.
The deal is it's an all-share combination where Eni's basically handed its UK division, which is North Sea producing assets, to Ithaca, and they'll take about 38% of the share count through newly issued shares there. It's effectively a strategy that's quite different to what we're seeing elsewhere in the North Sea, where Harbour has done this huge deal with Wintershall DAA to move into Norway because they say that the North Sea on the UK side is no longer investable because of the higher taxes. But Ithaca is sticking around. It's increasing production through this deal to about 100,000 barrels of oil equivalent per day. So that's the kind of broader context to these results, because the company will be changing quite quickly. What they've reported is basically a reflection of lower production. Things didn't go that well in the first half on an operational basis. So their sales are down, and also lower oil and gas prices have knocked those sales as well. Profitability, it depends how you slice it, really. They've said that their cash profit with exploration costs also taken out, which is an industry standard figure, EBITDAX. It's about $500 million. That's down from about $1 billion last year. But once you kind of chop away adjustments and the realities of being an operator, it comes down to a net income of about $100 million. It's also down, but down to those factors that I just mentioned.
Mm. Yeah, that production is an important part of it, because there have been some suggestions, I think even this morning, hasn't there, that the windfall tax has caused the drop in profits, whereas it's more to do with production. But what is the impact? What are they saying at the moment about the windfall tax? And also, what's the latest on that front? Because we're still waiting for some clarification, aren't we, from Labour?
Ithaca is a really interesting company to view this through, because they do have some big. They have one really big project that's they've given the green light. Rosebank, one of the biggest field developments that we've seen in recent years, and they've pushed the forecast production out to, they say 2026, maybe 2027, but that's moving ahead. Where the I guess the decision marks fall are things like Cambo, which is another really big field development, and Ithaca is trying to sell off a portion of that project to get it funded. They pushed out the exploration permit for another few years, so there's a bit of time to play with there. But also, they've continued to invest in their other assets. So they've got the Captain field, once again North Sea, and what they've looked for there is kind of quick investments that can increase production, and because all of the infrastructure is already in place, it's quite value accretive quite quickly, and that's what they've stuck to in the past 12 months or so. They're quite happy to keep doing those investments. The big question for Captain, and I spoke to the previous exec chairman about this earlier in the year, is they have this plan to potentially electrify the platform, and it's effectively connecting it to the grid. And if you think about the practicalities of that, it's a huge undertaking. And the former boss, Gerald Myerson, he told me the cost would probably be about $350 million, and it's a significant spend. And that's something they're saying they will do if the conditions are right. For the conditions to be right in their eyes, I think the industry's acknowledged that Labor's not going to take back the 3% that they've added to the windfall tax. So the overall tax level is 78% now, alongside Norway. Where the UK now differs significantly from Norway is how you can offset that tax. And the reason the producers such as Harbour talk up Norway a lot is because there's really strong offsets. So they encourage companies to spend a lot on expanding production, on updating facilities, on that kind of thing in the offshore region in Norway. What is up for question now, and what we'll find out in the budget, is just how much Labor is willing to let these companies offset their spending. If there is zero offsetting, I think it will be pretty disastrous for the business models. I mean, they've built these assets with certain assumptions in mind, and I don't think even in their most pessimistic scenarios that they would have thought there'd be no offsetting this spending. And in some ways, they're also just asking for the same treatment that the onshore companies get, which is Jeremy Hunt brought in full expensing. There's these capital allowance rules that are designed to keep money in the UK. And the industry is in the midst of a really big push to convince Rachel Reeves to allow them to basically balance out some of that tax hit. They're not asking for, massive I guess, freebies from the government. They're just asking for that capital allowance system to support a little bit of spending. And I mean, it's up for grabs, really. I think the question is whether Labor's more determined to stick to that £6 billion target in terms of new taxes raised. There's an analyst, Chris Wheaton at Stifel, who says under the current plans that'll actually raise £4 billion. So they might need to cut those capital allowances, but then that has the other impact of reducing production and therefore the tax take in the later half or the later part of the decade. So there's a lot of levers here, and we had this morning the industry lobby group Offshore Energies UK send a letter to the government and then talk about that letter on the BBC about what they see as the real impact of these policies, and it's hitting the smaller operators who maybe not so much Ithaca. They are very North Sea focused, but it's a big company. They're talking about the Serica size companies that basically are just earning in the North Sea, as opposed to Shell and BP, for example, who were really held up as profiteers when energy prices spiked in 2022. But the industry is trying to make the point that they're not that impacted by these taxes. So yeah, it seems to be up for grabs at the moment. I'm not sure how that's going to play out.
Yeah, well, it's only a couple of months now till the budget, so we'll get some clarity there. Politically, you think it would be difficult for them to lower that $6 billion figure, but we'll see what effect all this discussion has. Let's talk about the size of the company. You say, of course, Ithaca is not one of the smallest, and it's about to get a decent size bigger as well with the NE deal, and there'll be a new chief exec, I think, as part of that too. But what does that give the company? How will that change how the business looks, and also what are the prospects? It's quite hard to perhaps to value a company like this at the moment. Is going to be the answer, isn't it? Based until we know what happens with the windfall tax. So, but those two things in turn.
I think so just to sketch out the post merger company, they should have this finished by the end of the year, and it essentially means it just grows in production size. I think NE's not brought any huge development projects to the table. It's just basically a quick hit increase in size and cash flow, and they say it'll immediately add to the cash flow of Ithaca 2.0. I think the interesting thing for me is how willing they are to use the balance sheet to keep paying dividends, and they've kept that deal going, or they've kept an idea going of paying out $500 million in both 2024 and 2025. They paid out 400 last year through dividends and special dividends. They're running a reasonable amount of debt. I think liquidity is at $1 billion and net debt's about $650 million, and they're quite happy to keep it at that level alongside quite significant payouts. And combined with the share price declining this year, I mean, the share price has fallen basically since Ithaca came back to the market in 2022. But the yield is now about 20%. One thing for investors who, despite all the tax talk, see that yield and have some interest, it has already got quite a low free float, and through the Israeli company Delek, who relisted Ithaca, they're still a significant shareholder. With this NE deal, the free float as a proportion will fall. It'll basically leave the same number of shares on issue for retail shareholders in a bigger pot, if that makes sense. And that this is something that Harbour looked at. I mean, it came to the market. I think initially it had a free float of something like 10 to 20%, and the owner slowly sold down and increased that liquidity. But that's something that management hasn't given a clear plan on. And I mean, they asked about it on the analyst call this morning, and as soon as you say we're going to increase liquidity by selling massive amounts of shares on the market, that's obviously going to send them one way. So fair enough on not giving a very detailed plan.
Yeah, but something to be aware of.
Mm.
The other thing that struck me is the $350 million, I think you said the Captain Field electrification project is about what Hargreaves Lansdown will spend on replatforming their technology. It feels like one of those numbers should be different, but there we are. On that slightly unusual note, we have come to the end of today's show, though. We have run out of time, but thank you very much, Alex. Thank you to Val, to Mark, to Julian, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.